Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. I've got about £3.5 million worth of property, and on this channel we talk about all things investing, entrepreneurship and the like. And today what I wanted to go through is some of the biggest mistakes that I personally believe that investors make. And before we get into the video, one of the biggest mistakes people make is they don't subscribe to this channel. So if you haven't already subscribed, why not consider subscribing? We have our subscriber dividend portfolio, which is currently a bit higher than that, Tom. It's now at 5,500. And every single month, actually from now on, I'm putting £2,000 in, and we're going to pay out the dividends from that to our subscribers every single month. All you got to do is subscribe to the channel, like the videos, it massively helps me out with the algorithm, and comment down below as we go along. So the first one that I've got on here is trying to time the market, and it's been proved over and over again. Nobody actually knows what's going to be going on in 1, 3 or 5 years. Not with any level of accuracy and not with any level of certainty. So trying to time the market really is a fool's game. There are a lot of people who claim to be able to do it, and you have to remember that it's very, very attractive when people get it right. It looks like they're geniuses. But over the long term, there's something known as reversion to the mean. And most funds and most people will revert to the mean over the long term. The reality is that under 10% of actively managed funds manage to beat the index that they're trying to beat over a 10 to 15 year period. When you take fees into consideration, that number becomes smaller and smaller and smaller. So these are active managers that are going out marketing to you, saying that they can beat the market, they can time, they can move in, move out, go long, go short. The reality is, over the long enough period of time, they revert to the mean. The first thing that I quite often think that people get wrong is they try and time the market, which is why my strategy when it comes to my personal investments is all about dollar cost averaging, and that comes to property and stocks and shares. So every single month I pay into my ISA, my pension, my stocks and shares fund account, and that's a fixed amount every single month based on my budget for that year. Same with property. If I only had £200,000 over the next 3 years to invest, then I'd probably do a third, a third, a third. And that way I make sure that I dollar cost average and I smooth out any bumps, because I want the long-term returns. That's what I want. And that really feeds into number 2, not thinking long-term. And I think that really comes down to asset classes, right? Ultimately, in the long term, if you're talking passive income, there's only 2 asset classes that have been proven over and over again to be reliable sources of passive income. And that is public markets. And I mean by that the FTSE 100, the S&P 500, public companies that are out there being run on your behalf. And you buy a share or you buy part of the index, and over that period, that company's run on your behalf and the profits are shared with you. The second one would be property that you own, but maybe you don't control, i.e. you rent it out and you let an agent manage it, etc. So those are really the only 2 really passive generating, kind of income generating assets that you can think of. If you think of gold or anything like that, it's very speculative and it's only worth what someone else is willing to pay for. Crypto, same thing. Ultimately, in my experience, public markets, property, those are the things that when I speak to people who are worth a lot of money, that tends to be where the money is parked, in those 2 things. And they're always thinking 10, 20, 30 years in advance. They're not thinking about, can I buy this stock and turn it around in a year? So thinking long term, I think, is key. And it really feeds into not chasing unrealistic returns, which is my 5th one. I'll give you some examples of that when we get down there. But by thinking long term, you're not putting the unrealistic expectations on your portfolio to return everything tomorrow. And by doing that, you're going to protect yourself into not making the mistakes that lots of people make. Number 3, underestimating costs. Now this is really property related. One of the biggest things I hear about from people is when they've taken on a project, they've expected to maybe buy a house for 100,000, spend 30, and it's going to be worth 150, something like that. And then halfway down the project, they found out this 30 is more like 50, and suddenly there's no profit in the deal. And what I would say about underestimating costs is, as you add complexity to a project, as you add more moving parts, i.e., let's say for example, a property needs a kitchen, a bathroom, a rewire, the more things you take apart, the more problems you are likely to uncover. And as you uncover more problems, you're going to increase your costs. Also, the longer it takes you to do it, the more the finance financing costs increase. The longer it takes you to do it, potentially, the more costs increase as materials and labour, etc. become more expensive over time. So underestimating costs seems to be one of the biggest things that I see people get wrong. And myself, I've fallen foul to that many times as well. I remember to my property in Corby, I bought it for 116. So I was going to spend, I think, 30, and I ended up spending like 42 or something. So 12 grand overspend because we had to renovate more than we thought we were going to have to do. Some extra windows needed doing, the property needed rewiring, you know, it all adds up, and before you know it, another 12 grand's gone. Luckily for me in that instance, the property became worth about 200, I think it was 220 in the end, but let's say 200. So I had enough money in the deal to make it work. But not having enough wiggle room in the deal or enough fat in the deal is a big problem when you're underestimating your costs. So that is something I think people need to be really, really realistic about when it comes to property in particular. Number 4 is paying too much in fees. And again, that could be in property, it could also be in stocks and shares and funds. For example, if you're buying ETFs on the HL platform, for example, I pay a maximum of £45 per year in fees to HL. And then if you look at my Vanguard fees, on the S&P 500, I think it's 0.6. On the FTSE 100, it's 0.9. Oh, 0.09, sorry. It's much, much lower. So these are very, very low fee based. If you look at, for example, maybe hedge funds, they're generally 2 and 20, which is 2% of the overall thing that you have under management. So let's say, for example, you've got $1 million, you're paying 20 grand regardless of what they do, and 20% of any profits they make. And again, when there was this big study done against hedge funds versus index funds, I think it was Warren Buffett who made the bet, wasn't it? That I'm looking at you, Tom, like you know. You don't, do you? But you can bring up an image of this, right? Warren Buffett made a bet of the top 5 hedge funds. He betted them that they couldn't beat the S&P 500 over 10 years, and all of them failed. The money went to charity. It was a good experiment, but ultimately he was trying to prove that they can't justify this level of fees. Obviously, not much media about this sort of stuff because it's a lucrative industry, but these actively managed funds, quite often when the fees are taken into consideration, they cannot beat these passive funds. So for me, I've got very, very low fee costs. If we then relate it back to property, for example, if you put a bridging finance in place or something like that, the minimum you're going to pay really is going to be about 6 or 7 grand. And that's even if you turn it around quickly and it's a low level of finance. So let's talk about the fees that you're going to pay on that. You're going to pay a couple of grand arrangement fee. You're going to pay about 1% a month. And that's rising all the time. 1.25% is not unheard of at the moment as interest rates have risen. Add all that together along with the refinancing fee onto a new mortgage, you're looking at 6, 7, 8 grand, maybe even 10 grand on a 100 grand purchase. It's a big proportion of the profit if you're only going to make a 20 grand profit. So you've got to be really careful about fees when you're building out a deal. Certainly in property, and when you're investing in index funds, you've got to look at your platform fees as well as the management fees, because those two things can kill your investments. You've looked it up, haven't you? What was it? Was it Warren Buffett that made the bet? Otherwise, all of that was bullshit. Number 5 on my list, and the last thing on my list, is chasing unrealistic returns. And there is a statement in The Richest Man in Babylon I love, and that is gold flees from those that expect unrealistic returns. And the real warning of that is, if it seems too good to be true, quite often it is. Because capitalism doesn't really allow you to create massive returns with zero risk. I remember somebody saying to me, Mark, there's this cryptocurrency coin, it's going to get 100x for the next 3 years. I was like, dude, if I put £1 million in, I've got all the money in the world in 3 years. This is not possible. So chasing unrealistic returns is really, probably actually the biggest mistake that people make. What are realistic returns? I think that's what we should talk about, right? If you look at the S&P 500 over the course of many decades, you're looking at about 10%. If you look at the FTSE 100 over many decades, dividends reinvested, you're looking at 7 to 8%. So we're sort of seeing the numbers that you can expect, aren't we? It's about 7 to 10%. If you look at property and how that grows over time, it's about 7% over time, compounded up. It obviously has the benefit of property having leverage, you know, so you've got a mortgage, the rent pays the mortgage, the property increases in value. Let's say, for example, you bought something for 200k, you've only got 50k in it. and let's just say that the mortgage covers the rent, nothing else. Let's just make it really simple for ourselves. Over the course of 10 years, that property becomes worth 350k. Well, actually, your net return on your 50k invested is huge. And that's why property is favored by a lot of investors. Very difficult to do that with funds, although not impossible. There are lots of ways of leveraging up on funds, and we'll do another video about that on another day. But unrealistic returns, that is where people become really unstuck. Because I understand how attractive a 30% return is, right? 30% is incredible. Do the maths, put some money in, compound it for 20 years at 30%, you're going to be a very, very rich individual. The reason it's not possible is that everybody would be a very, very rich individual. So capitalism stops that from happening, and these are the realistic returns that you can expect in the markets. Have I missed any of the biggest mistakes? What do you think I might have missed out off this? Put it down in the comments. I'll answer every single one of you guys. Thank you so much for watching, and I'll see you on the next video. Cheers, guys.